All right, we'll look at the internal controls related to cash. So the nature of cash. What's cash? You have coins, you have currency, you have checks, you have money orders, you have money on deposit. The reason, especially in financial analysis, why cash is such an important number is because a lot of things in accounting have estimates, they're subjective. Well, cash is real. When you look at cash, you either have the cash or you don't. So here's a look at cash received from sales. So if we look at our customer, in this case at a retail store, they pay cash at the cash register to the salesperson for their goods. And then if we follow it down, the cash goes into a safe, the safe goes into a cash deposit, which is deposited into the bank, and that deposit ticket from that deposit into the bank goes to the accounting department so they can do a journal entry to record the cash. If we go from the cash register up, the sales receipts go to the accounting department so they can record sales. So here's an example of cash received in the mail. So a check's in the mailbox, you have somebody opening the mail, and they create what's called a remittance advice. They take out the remittance advice, which what that is when you get, say, your electric bill, there's that piece on the electric bill you put into the envelope with your check when you send in the payment that has your account information, the invoice number. That's called a remittance advice. And then the other thing in the envelope is typically the check. So when you mail in your electric bill, you send in the remittance advice and you send in the check. The remittance advice goes to the accounting department, and then they make a journal entry to record the collection of cash. So they debit or increase cash, right? The check doesn't go to the accounting department. The check goes to the cashier's department, which is typically like maybe a treasurer, and then that's deposited into the bank. So why would you want the remittance advice going to accounting and the check going to the cashier's department, which is not accounting? Well, if both the check and the remittance advice both went to the bookkeeper in accounting, they could just take the check and then there's no record of it ever coming. So this is good internal controls. Somebody opens the mail, they send the remittance advice to accounting, the check to cashier's department, and in the end, the cash that we record in our journal entry should equal the cash that we have ultimately in the bank. That way the person in the accounting department can't shred the remittance advice, cash the check for their own, and take the money themselves. There's controls. There's two people. There's the cashier and the accounting department doing two separate roles, but in the end, the cash in the journal entry in the accounting record should be the same as the cash in the bank. This is good internal controls for cash coming in the mail. EFT is very popular now. EFT is electronic funds transfer. So if you ever pay your bills online, so you have the Comcast bill automatically coming out of your bank account, what will happen is the money goes from your bank to Comcast bank, and then the EFT notice goes to the accounting department, and then the accounting department makes the journal entry. The cashier's department is not needed because the cash is already in Comcast bank. So nobody in an EFT perspective is actually handling cash. It goes from bank to bank. Whereas when cash is received in the mail, somebody's handling a check, and a check is actually considered cash. EFT, nobody's handling cash. It's an electronic transfer from bank to bank. So from an internal controls perspective, as you can see, EFT is much better, much easier to maintain than receiving a check in the mail. So if looking at control over cash payments, some documents that we have. So we have an invoice, a purchase order, and a receiving report. So an invoice is what we get from somebody we're buying something from that we have to pay them. A purchase order is what we sent to our vendor saying that we need something. And a receiving report is when the goods arrive, we receive a receiving report that it actually showed up. And then what a voucher is a document which is an approval to pay an invoice. Once that voucher is approved, it goes into the system, and then every so often, all those vouchers are viewed and checks are cut to the different vendors.